Well, hello and welcome to the Mutual Fund Show. I'm Neeraj Shine. Over the next 22 minutes, we'll kickstart this year's Mutual Fund Show series, so to say, with a set of questions which seem to be very pertinent at the current point of time. No, it's not a show that looks ahead into 2022 and crystal ball gaze. So we aren't doing all of that. We're not going to dissect 2021 as well. That's long done. I think we're going to talk about the here and now and the key topics facing mutual fund investors. Now, a couple of announcements that stood out for us in the last 7-8 days. Some of these maybe came in toward the end of December, but we are bringing them to you right now as we saw it. So SEBI, for example, Chairman Ajay Tyagi on Tuesday, day before yesterday, or yesterday rather, said that the market regulator does not want mutual funds to come up with new fund offers based on crypto assets until the government has announced regulations for cryptocurrencies. I reckon there was one fund which is trying to do this. I do not know the future of what happens, but yes, everybody's wanting a slice of crypto. The mutual fund route may not be open just as yet. There's also something that we saw which said that the winding up of mutual fund schemes will be possible only after majority unit holders consent. And this could have, I'm not saying this could have major implications, but I reckon in some fashion or the other, this is also a positive from a unit holder's perspective. So a couple of announcements that came across. Now to the 2 or 3 key topic points that we wanted to discuss with our 2 guests, and both of them are with us on the show today. Vishal, Dhawan and Kshitiz, Mahajan. They need no introduction. They've been on the show a number of times. And gentlemen, both of you, thank you so much for joining in and wishing both of you a very, very happy 2022.
Very happy.
Sorry, I should have maybe asked one of you individually. But
Vishal, so wishing both you and Vishal a very happy and prosperous new year. Vishal, please.
Thank you so much, and to you as well, and to all the viewers also.
Thank you so much. Okay. Yeah. So let's start that way. I mean, there are 3 topics that we thought we would want to discuss on this show. So the first one is, of course, this whole conversation around whether a Capex cycle is imminent or no, and if that is indeed the case, then how do investors play it? Now, Kshitiz, I'll start off with you. Let's not get into the argument of whether it will happen or no. My point is, with an assumption that if there is an investor who's heard various market experts and believes that a Capex cycle is imminent, is not into direct stock investment, and therefore she wants to use the mutual fund route, how does she go about doing it?
Neeraj, and I'm glad that the team brought this topic up about the Capex cycle, which is turning around. And you're right, we should discuss here the broader picture that if somebody is actually eyeing to participate in this upturn of the cycle, then how one can do that. So there are a couple of things which I will like to bring that, this turnaround of cycle will not be it'll be a different turnaround of cycle, not those typical cycles where you have cement heavy, or let's say some industry heavy cycle. This can be a data driven or maybe technology or digital driven cycle. It's a very different, millennial cycle I'm talking about, which we are living in, and things will become very different. So, but the scale at which this will happen will be very big. So people should be little, clear while we are discussing this on screen. They can do their homework at their end also. That one is that you can play a pure play on the Capex side, which is a typical infra fund, story which you can look at. You can look at any of the infra offerings or natural resource offerings of various mutual fund houses. But second is that you can play through a broader focus or a multi-cap fund where you can get where you can get a dummy play of this cycle turning around, as well as it's been well shielded by, if let's say this will not happen, then you have a broader portfolio which can take care of many of the downside which one can look at looking at the cycle. So I have a view that this is my personal view, please, that one should look at playing it through a multi-cap or a focus fund, or one should look at if they are going for a pure play on an infra fund or a sectoral approach through infra or mining fund, that this cycle might be turning around, and the beneficiary will be a lot more different sectors and new evolved sectors than what you are eyeing right now.
Interesting perspective. Vishal, what's yours? And it could be materially different from Kshitiz, but if someone believes that the Capex cycle is underway, how does one play it via the mutual fund route?
So we think that, first of all, there is this fear around Capex because people got it so wrong in previous cycles that they are very hesitant to become bullish on that cycle at all. And what we've historically seen is that, when you have a consensus view that exists that something is not necessarily going to do well, I think that's the time where, you can be surprised. And we therefore think that it's probably one of those few times where it's good to look at this theme in a slightly narrowish manner, where you start to go back to infrastructure funds and look at them once again. If you look at infrastructure funds as a category, there are obviously two methodologies that funds have put together. One of them is where they are purely focused around, Capex companies, materials, and a little bit in utilities and telecom, for example. So those are what we would call the pure play infra funds. And then on the other side, you have these diversified infra funds, which also include, for example, the financials, because they are financing a lot of this infrastructure in theory. And therefore, our view is that if you want to play infra and the capital goods space appropriately, then it's good to go to the pure play players rather than going to the more broad-based exposure. And there are probably a couple of funds within that space that stand out from the research that we do across funds. One is the Kotak Infrastructure and Economic Reforms Fund, and the second is the L&T Infrastructure Fund. Both of these are driven by the fact that they've had consistent track records, they've stayed pure play, they focused on quality, because this is a space in which we think a lot of damage historically has happened because players have taken more risk on their balance sheet than what they could handle. And what you want to be careful about is not repeating the same mistake. So even though these funds may look a little more expensive from a valuation perspective, these have actually worked well historically in protecting downsides as well, whenever things go wrong. I think just one additional factor that I would sort of want to focus on is that I think people may have to build this exposure gradually to cut the risk of what Kshitiz was also mentioning, that maybe this cycle happens later than what we are imagining, or maybe the investment phase of that cycle doesn't make you money as an investor. You start making money when a lot of these infrastructure assets are actually deployed and cash flows start to come in. So I think getting in gradually would be an important part of the strategy as well.
Vishal, just a follow-up. So with the presumption that somebody believes that they want to play to the infra fund or by the couple of funds that you mentioned, what's the extent of the portfolio? Let's say you are very bullish on this cycle. You would still have some the risk balancing in mind. So what's the extent of your mutual fund portfolio? Would you expose to such funds?
So we would typically not go beyond 10%, because there will be a lot of the diversified funds in the portfolio also, which will be taking some of these bets by default or by choice. And therefore, the way we look at it is a 10% exposure plus whatever you're getting through other managers would actually end up being quite sizable.
Okay. Kshitiz, you are obviously not opting for the infra funds, in which case, as a generic rule, what are the funds that you reckon would probably have this exposure to some of these categories? I heard you mention the flexi fund route. I heard you also mention the digital fund, digital assets theme maybe, and there are some funds out there. Would you do a mix and match of these, and therefore what's the extent of exposure would you recommend as well?
So Neeraj, I see there are 3-4 good fund options, which at my level, which will give you what Vishal is also talking about, a play on the infra theme. One is Aditya Birla Pure Value Fund. Second is HDFC Focus Fund. Third is a DSP Tiger Fund. And there's one Kotak Infra and Economic Reform Fund, which is a combination of what we are talking about infra as infra story as well as the economic reform story, wherein you have banks play and certain companies play, which will gain from many of these new ideas which are coming up. Now, on the capacity utilization side, I'll just take 10 more seconds. On the cement side also, I see that they have decided to add up more capacity on the table for cement also, but still 100% capacity utilization is still not there. So I'm not saying that will not do well. Infra part will do well, and I totally agree with what Vishal is saying, that yes, you can look at allocating some portion, but for me, it's like healthcare or technology is still, you can say, a long-driven sectoral bet. But when it comes to infra, I still want to play a little safe for client portfolios, because it's always good to go through a focus strategy, because in these funds also you get industry play, you get capital goods play, you get your real estate play, every play you get in these funds also, and various sectors allocations are there in these ones. Second, when you talk about that, when I talk about the digitalization part, or let's say initially we used to have a more and more power plant coming up, and money used to go in 2006-7 cycle in those type of projects. Now it's more of clean or renewable energy part where money is going.
Right.
So the cycle is changing a bit when it comes to the new capex which is happening right now. Similarly, when you talk about data sciences is one thing. I was talking to Clear Water Analytics in US yesterday night. We were having a call about some data part, and they're talking about in India the cost of a basic data. Let's say Kshitiz, his age, his name, his house number is $1. In US it's $7, and that data, because everybody, I will not like to quote, that data becomes a big thing now, because on that data you can actually take out an investor behavior or an individual Neeraj or Vishal or Kshitiz behavior. So that part will also become very big. So new developments, government is also eyeing the data part very importantly, because our country is working on that data, and thanks to the data part that we are able to do a lot of things. So I see that broadly, one can look at these funds wherein you have a good play on the sectors which I mentioned, as well as you have a broader themes which are playing, and secular themes which are doing well.
Got it. Okay. Thanks for that, Kshitiz. So those are, some options. And by the way, disparate views, and both views could be right or both views could be wrong as well. The larger point being, whoever's viewers you kind of align with, and there's some overlap, yes, but whoever's view align with, you can probably try and think along those lines, maybe consider some of those funds. But of course, as we always say, please do your own homework as well. Now to the next topic, and Vishal, I want to start with you on this one. A couple of launches, and would want to understand what do you guys think of it. So SBI Mutual Fund announced the launch of the SBI CPSE Bond Plus STL September 2026 50/50 Index Fund. What is this fund about, Vishal, if you've gone through it, and what kind of investors should choose this, and are there better options available in that category?
So I think this is a category of target maturity or target date funds, which is gaining a lot of prominence. We've seen a lot of funds come into that space over the last few months, and it's clearly come in there, created a new category, garnered assets, and I think it's appealed to some very basic principles which fixed income investors always have tended to have, because they've been used to investing in products like fixed deposits, saying, when will this mature? And what kind of return should I reasonably expect out of this? And I think both of these questions were always a struggle to answer in the traditional debt fund world, simply because they were all largely open-ended products, and they didn't have a date, therefore. And the kind of return that you would make depended on so many different variables, which were very complex for retail investors to really understand. So I think this category, has one more player come in through the SBI fund. Most of them are very, very similar, looking at a 4-5 year sort of duration, because that seems to be the part of the yield curve which is relatively looking attractive from a medium-term perspective. And the other advantage that sits in there is, because you're holding to maturity, you can probably overlook a lot of the mark-to-market that will happen along the way as interest rates move up on the back of what's happening on the inflation side. Last but not the least, I think the low expenses are very useful in these categories, because I think what tends to happen for debt fund investors is that in a low interest rate environment, if you have a lot of expenses on the fund, you further end up losing money. And therefore, a lot of the funds coming in there, including SBI, are priced at about 15 basis points for direct plans. And therefore, we think it's a good space. Unfortunately, not a lot of differentiation in there. All of them are doing similar stuff. They're tracking a similar index, 50% going to state development loans, 50% going to, to PSUs. And obviously that index gets reconfigured every 6 months, at which point, if there is any rebalancing to be done, that will happen. We've seen only one little variation from Birla come in more recently, where they try to change the weightages. But otherwise, these are all fairly similar products. So I think for investors, depending on when they probably require the money, 26, 27, whenever, they actually go in and buy into one of them.
Okay. Maybe being homogeneous is not a bad thing, viewers. You don't have to take so much of a headache in terms of choosing. Just look at the maturity dates and maybe that works for you. But thanks for that, Vishal. Kshitiz, same question. And is there something else that you would want to add to what Vishal has said? Of course, your view may differ, but just trying to figure out maybe a better fund in that category, or how do you like the category? What kind of investor should go for this category?
So Neeraj, it's an open-ended FMP, I'll say. FMP with a maturity, and if you hold the paper till the maturity, you'll get the benefit out of it. Am I audible, Neeraj? Okay. Okay, it's an open-ended FMP. You have 7 paper on CPSE, 11 paper on SDLs, 18 papers, rightly said by Vishal, low expense. So I say that these type of funds are become relevant and important for people who are a fixed income, or let's say who are a FD clients. So when they look at their fixed deposit, normally the income which get generated is an interest income. Okay. But in mutual fund, when you participate and you roll over more than 3 years, it becomes long-term capital gain with 8% with 20% your indexation tax. That's what you get. So right now somebody is participating and rolling over for 3.5 years. You get 4 indexation benefit. The entire money which you get will become tax-free. So I'm saying these type of funds are relevant in scheme of things of clients who have fixed income allocation. Rather than putting in deposits, you can look at this side of the portfolio. Second important point is, in this category, you have Edelweiss Bharat Bond Fund also, whose yield is little better than what right now been offered. It is just that paper is for 10 years. And moreover, the open-ended nature of the fund allows you, if tomorrow there is no mark-to-market loss which you are having on the portfolio and you need money, you can move out also after 3 years with a taxation benefit. So that's the only differentiation which this entire portfolio has created, and why this type of portfolio is also required. I know it's run-of-the-mill, boring, same old style portfolio, but investing is like that, because many clients are looking at safer horizon and they want to park for 5 years or 10 years, wherein they can get this type of yield. Tomorrow, you don't know. I am not saying that whether yields will strengthen or go down. I am not commenting on that. I'm saying today you're locking a yield at 6.1, and that yield will remain with you for 5 years. And when you take indexation benefit, you normally get almost post-tax also similar type of return on the paper. So it's a good option for asset allocation fixed income side.
Got it. Okay. And thanks for those nuances as well. It would be interesting to look at those options too. So both of you, thanks for that. Kshitiz, I'll start with the second question on this new launches piece. And 2 large fund houses have launched an auto ETF. So should investors who have a bullish view on autos take an exposure to either of them? Is this ETF a good way to do it because it would be lower expense than an average fund? What do you advise?
They should have launched some EV policy for their employees rather than launching an auto ETF. So that's what I'm eyeing from most of these agencies. So I don't see that there is any need for auto ETF. If you actually see, it's a very new space, Neeraj, and a lot of innovation is going on. EV, I've been talking to a couple of EV new ventures for which we are raising capital, and everybody is saying that I'll have a better mileage, I will have a better production, and it's very new, very nascent. But on the auto ETF, Nifty ETF side, you have top 15 companies, like Maruti, Mahindra, Tata, Ashok Leyland, Eicher Motors. But I'm saying all these big companies, except for Tata and Mahindra, who are looking little promising on the EV space, I have not seen much of action from any of the other companies as we talk right now. So I feel that you have many funds like auto as a sectoral weightage in Nifty is close to about 5.8, 5.9. You have many funds like IDFC, FlexiCap fund, which has 7.5% weightage towards auto. There are many more funds which have an auto weightage. So maybe it's they have launched it, that's okay, but I don't see that someone should look at participating separately in an auto ETF per se allocation, because auto has not done in last 2-3 years, and this entire Capex will help auto to all to do well. In auto, which all sectors will do well, which all companies will do well, nobody knows. They don't have Minda, they don't have many of the other companies which are doing well, which are not a part of Nifty as a constitution. So somehow I'm not comfortable allocating funds towards this ETF.
Got it. So 2 ETFs, viewers, and Kshitiz doesn't quite believe in that. Better routes to invest, according to him. Vishal, is your view similar or is your view different?
Yeah, so I think broadly similar. I think the EV disruption by startups is certainly a risk that exists. You don't know where that next Tesla in India is going to come out of, and therefore you're just going out and diversifying across a lot of players. I think what's fairly interesting though is that as a space that sector has struggled through the last few years, and therefore for a lot of investors who are both aggressive on one side as well as want to be contrarian, I think that segment of individuals may find that there is merit to come in here, because at the end of the day, it is a relatively lower cost solution coming through the ETF route. The costs are likely to be more like between 20 and 25 basis points. So if you want to be contrarian and aggressive and say that some of the big guys who've been there will also figure out how to solve this problem, like they figured out how to solve so many other problems in the past, I think then you could allocate a portion of your money. But otherwise, you're just better off playing this through a diversified portfolio.
Because you have an answer, two NFOs or two offerings, and I think usually people get attracted by offerings because of advertisements, etc. Both our experts believe that there are better ways to play this. Moving on to the final thing, I did say that we are not crystal ball gazing, but what we will do is try and ask our guests the one key theme that they in mutual funds that they believe people should latch on to. Now, it could be a debt scheme, it could be an equity scheme, it could be a BAF, it could be what have you. There are multiple options available. So you left this open-ended. Now, the recommendations may suit your profile and your portfolio. It may not, but it may be worthwhile to hear what is it that each of my guests believe they like, and why is it that they like it. Vishal, can I start off with you?
Sure. So, it's very interesting that this is the first show of 2022. And I remember being on your show either in 2016 or 17 and actually talking about exactly the same scheme. And it's fairly interesting that, while you're looking for a new idea, actually, we think that sometimes there are just ideas that have played themselves out very well, which need to continue to get allocation. So the scheme that I'm going to refer to is called the Parag Parikh FlexiCap scheme. It's, of course, at that time, it used to be called by a different name before the recategorization by SEBI happened. But in essence, the fund has always been run the same way. And I think what they've done successfully over the years is taken advantage of the fact that on the India side, they've bought into businesses that they've had a lot of conviction on. And they've obviously held on to them for long periods, which is why we like the fact that they have a below 20% portfolio turnover ratio, showing that conviction through long cycles. And on the other side, they've had about 30% allocations to international stocks. A lot of them plays which you can't really buy into India through. And therefore, that has been very helpful in this cycle. So the value orientation from an India perspective, maybe a little bit of a growth orientation internationally have combined well together. You've had a very consistent fund management team. You've had them sticking to philosophy. You've had, skin in the game far before SEBI made it mandatory. And I think all of that goes well for investors who want to take a forward view as well. Maybe not 2022 only. Maybe 5 years later we'll be talking again and still saying that this is a good option to add to.
Yeah, it's very interesting. I love the advertisement or the literature that they've put out, that if you like too much of activity, if you like this, if you like that, then you'll be disappointed. They're not shying away from actually saying that they are the old school boring kind of investors, which is amazing. Just one quick follow-up, Vishal. Their AUM 4 years back was much lower than the AUM now. Typically, people tend to correlate the size of the fund with the ability of the fund to outperform. Do you think that could be a hindrance or no, not really?
We don't think so. In fact, it's very interesting that when we used to have this conversation 5 years ago, the what we used to hear back was, it's such a small fund. Really, is this going to be getting enough attention? And today that conversation has turned around. But I think, again, if you look at the size of the fund, it's about 18,000 crores now. The size of the market has become so much larger that we think a 18,000 crore fund, which is not biased towards any market cap style, has enough opportunities to really participate in. And I think what does work well for them is they haven't shied away from taking cash calls if needed, unlike a lot of other managers. So if there is overvaluation, which I'm sure there will be at some different points across a journey, you would expect that they would take some of those decisions to hold back on investing.
That's a fair point too. Vishal, thanks so much for that. Kshitiz, what is it from your end? Again, it could be debt, equity, what have you, and why?
So it's equity and it's HDFC 30 focus fund. That's what because I can correlate that with the topic which we discussed, the Capex side also. Again, it's a multi-cap play through which anybody can participate in that well-diversified portfolio at the same time, with almost 5-30% on the financial sides and 17-18% on the consumer discretionary side, 9% on your industrial side, and 7% on industry energy side. It has a very, very fair mix of both the plays wherein a diversified portfolio can deliver you the opportunity which can be seen right now on the Capex side, as well as cushion you with the large caps, because it's more of large capish portfolio. This has been managed by Gopal Agarwal and Dheeraj. You know Gopal very well, the guy who actually instituted the entire equity setup for Mirai, and then he moved to Tata for some time, and then DSP, and now he's with HDFC. So I really like the percentage variation they have done, because as you said, in your conversation with Vishal, that investing sometimes it is boring, but it is actually good, because boring is better in investing. Similarly, in a focus strategy, if you actually see, you take out the unsystematic risk if you are in more than 21, 22 stocks. That's a given law. So systematic risk is something which nobody can predict, but unsystematic risk is taken out almost 90% if you are in 21, 22 stocks. They are holding 30 stocks. And I see that this portfolio with the uptick on the both financial side as well as Capex side should and will do well. And we have seen Gopal has taken almost a year and a half back. We have seen portfolio turning around and started doing well. So I see that this portfolio one can look at. Again, this is my personal views. You can do your due diligence at your end. I see that this portfolio can do well.
Yeah. No, it goes without saying that viewers, whatever you hear from our experts, please do your own due diligence as well. But it is welcome. We call them because they study this day in, day out for a living, or however you, or their passion, and therefore they understand these things really, really well. But I'll take a moment to thank both Kshitiz and Vishal for joining in today and sharing their thoughts, and to you and your teams and families, wishing you both a great 2022.
To you and the team and everyone.
Thank you so much for having us over. Thank you.
The pleasure is ours. Pleasure is ours. And viewers, thanks for tuning into this very first episode of the Mutual Fund Show.